Good evening to all the listeners for this call. It's indeed very interesting time from the market perspective. Just when we thought that this year is going to be one of the smooth years, because when the year began, one was looking at a political stability, one was looking at a relatively benign situation in the world as well, and also one was beginning to look forward to easing of the constraints in the world markets, in the world economy, and easing of the interest rate as well. Just when one thought actually, so always the unexpected thing is the most expected thing. So it's not a surprise that many unexpected things have sprung up from nowhere. And as would be the own that markets have reacted in a manner, and sometimes it overreacts, sometimes it underreacts, but it does react at all points of time. Our job, and the most important job, is to see through this. So what I'm going to talk about right now has got three or four parts of my presentation. The first part is domestic macro. It is strong, very strong, in fact, and it is sustainable. So the growth will continue for a longer period than what people initially expected. The second part of the presentation would be with respect to the Indian capital markets. And within that, I'll focus a lot on the valuations, because that's something which concerns a lot of us, end investors, distributors, everyone. So we'll focus on that as well. The third part of the presentation would be about a couple of funds, and then how the thought process or the portfolio construction in those funds is aligned with the overall macro thought process. And so those will be the three sections, and then based upon the Q&A, I will incorporate my some learnings from the Europe trip and other trips, and what the FI investors are thinking at this point of time. So that's what would be the basic layout of the presentation. So moving on to the first thing first. And this is about the GDP growth rate. This is not our number, but these are the estimates by the multilateral agencies. Two or three points to be noted in this slide is, the first thing is that India, which is the fifth largest economy, will go on to become the third largest economy by 2027 if it continues to grow at this current pace. And by which I mean that it is the world leading growth rate that we have got right now, or while everybody else is languishing between whether there would be recession or not recession, or wherever the growth is there, whether it's going to be 1% or 2% growth rate. The growth rate in India in the past couple of years was 8%. In the current year also, it is likely to be in the excess of 7%. And in subsequent year also, it could be in the excess of 6.5%. So that will take us to the third largest economy by 2027. And the share of India in the world economy will also grow to become 4.5%. This is pertinent from the perspective that right now a number of investors till in the past were able to ignore India, because they were thinking that let's focus on the US market and in the developed markets. But that may not be the case when India becomes the third largest economy in the world. This growth, and this is the point I want to highlight, it coming in a very sensible manner, because there is a macroeconomic stability. It is not a growth which is on the steroids, that you do a fiscal stimulus, you pump in money and get the growth for a couple of years, and then there is a pain for many more years. Specifically from the using the language of the economy, then it means is that there is an excess monetary money supply, and there is an excess fiscal stimulus that is leading to a near-term growth, but that creates inflation for the future. It increases the debt burden for the future, and in the future, the growth slowed down. We don't have to look outside. In our case, in India's case also, that was the situation in the previous decade, because of the stimulus which was provided in the aftermath of 2008 global financial crisis. And that led to a situation that we had inflation in the range of double digits for next 3-4 years. The growth has stalled and became low till about 2018-19 or so, after which it has again begun to pick up. So a couple of data points which is important is that like in 2008, there was a fiscal stimulus and fiscal deficit went up. from almost 3% to 6.3%. Similarly, in the post-pandemic period, also the fiscal deficit went up from 5% to almost 9%. The gap, the increase actually was the extent of the stimulus provided by the government. But what happened actually is that in the global financial crisis time, for the next 4 years, the fiscal deficit remained in the 6% range, and that was caused a problem for the future as well. But in this case, we have seen fiscal prudence from the government, and the fiscal deficit has been constantly been coming down. It is projected to be 5.1% for FY25 and going to 4.5% for FY26. It is noteworthy, especially in the context of this being an election year. And normally, when we know that in the election years, the governments have tended to overspend so as to give either freebies or do excess investment so that it creates more jobs and benefit the people to win the elections. But the government in this case has been very prudent and is forecasting 70 basis point contraction in fiscal deficit. That will act as a headwind, but yet the growth rate could be in the excess of 6% real terms and nominal terms more than 11%. Look at the data in a different manner and the debt to GDP. And what we see is that the debt to GDP, this is the top right hand side, peaked at around 90% in the post-pandemic period. Since then, it has begun to slide down, and currently it is more like 81.5% or so. Now, this number will continue to slide down as long as the nominal growth rate is in excess of 10%. That is the third line here. And if it is grows at 12% nominal terms, then the debt to GDP will continue to slide down even faster. Right now, the nominal GDP is here at 11%, so we should expect debt to GDP to continue to come down. The next few slides, 4 slides, are for what are the drivers of the growth and why these drivers are long-term, not only benefiting, helping us grow in the near term, but will lead to a growth, multi-year growth in the future as well. The first point is with respect to demography. India has become the largest, most populous country in the world. So it's not only most populous, but is soon to have the highest number of working age population, overtaking that of China. Possibly it was already would have happened in 2024. The data is for 2022. Similarly, for the middle class as well, the India's share of the middle class population is again close to 19-20%, and that's when again it has got a disproportionately higher share of the middle class population. On the median age size, India's median age is 29 years, a good 8 years less than China, and almost 13 years from less than Europe, and 15 years less as compared to Japan. That means that the India's demographic advantage will continue to remain an advantage for another 20 to 25 years or so. And that is very striking and important from the perspective that the growth will simply not drastically come off the cliff. A natural outcome of the favorable demographics is that it should begin to show up into consumption, and especially that of the top end, the higher end of the consumption. What we see here right now in 2010 was this pyramid shape of the income distribution has begun to fatten at the top and narrower at the bottom. And by 2030, it will fatten even more at the higher end and grow, and basically will contract at the lower end. So number of strugglers will come down from 80 million to 64 million to 40 million. So in fact, this is 0.6x that of the overall growth, whereas the top end has been growing at 2.3% and 2.1%. So that means a number of people will move from the strugglers to next billion to aspirers to affluent and elite. And we all know that the consumption actually takes a big positive leg up, especially in these segments of elite, affluent, and aspirers. And again, why do we say that? Because India is a country of many states, and all those states are at different level of development. So while there are a couple of states at below $1,000 per capita income, the national average being close to $2,500. Some of the smaller states which are very rich has a per capita income of over $10,000, but some of the bigger states also have got a per capita income of $7,000 to $8,000. So we have got a whole spectrum of states at a different point in their journey of becoming from the low per capita income to little mid-level or higher level per capita income. And we see the consumption pattern of state A and B, which are in the sub thousand levels, is different from the one in the $6,000-7,000 per annum per capita, and the $10,000 is at a different kind of consumption basket which is there. So that's why I say is that looking at this pattern, and the same pattern would be replicated when India's average itself moves from $2,500 to higher $5,000 by the end of the decade, etc. Then the consumption basket and pattern will change, and that will be more discretionary and aspirational consumption in nature. So the growth in those segments is likely to be significantly higher than that of the staples consumption. The third part of the story is the India's infrastructure upgrade. Now, here again on the top left, we see that the capital expenditure has been languishing in the range of 1.5% of GDP for many years, till about 2-3 years back, and since then it has taken off. If you see the darker line on the top left, then that number shows 3.2% for last year and 3.4% for this year. This is capex to GDP, and this used to be 1.5% till about here. Now, this is more than doubling of the share of the GDP going into the infrastructure creation. This is only the public sector. Now, at some point of time, even the private sector also has to step in. If you look at the same data point, the what is the quality of the expenditure? That is a light blue line. There again, we see that what was 11% in 2021 is now 23%. So more of the expenditure is going into the quality and the productive assets creation for the future. If you look at some of the anecdotal evidences and some of the data points, is that the number of airports has more than doubled in the last 10 years, 74 to 149. The traffic, the aircraft movement, and the number of electrified rail routes, as well as that of the national highways, have grown by 60% in the last 10-year period. We should also note that this growth is coming responsibly. For instance, one of the targets for 2030 is 500 gigawatt of the renewable energy plant. Now, let me put into perspective. This 500 gigawatt of renewable energy plant was just 2.5 gigawatt in 2014. At present, also is only 70 gigawatt or so. We're talking about this number becoming 7x in less than 7 years. It's a huge commitment. Government alone cannot meet it. So this is also a commitment given by the private sector, respectively, in their own conglomerates and the companies, that they would be stepping up on the renewable energy target. It should be noted that from almost nowhere in 2014, it is close to about some 15% of the total installed capacity. But by 2030, more than 50% would be renewable energy. And even on an incremental basis, more than 85-90% of the incremental capacity is in the renewable energy. I'm highlighting this point because that is about the sustainability of the growth. We should not be investing in the technology for the future in the past, but should be investing in the technology for the future, so that the future economies can also benefit from this asset creation. The fourth and the final point, and this is the most exciting point of the driver for the economy in our country, is digital public infrastructure. We all know that the three elements of this one is Janadhan, which is the basic bank account, Aadhaar, which is the unique identity, and the mobile internet. And a combination of these three, what we call Jam Trinity, is at the forefront of delivering the welfare economies for the marginalized people. And as well as if you also look at the unified payment infrastructure, which is more than 100% of GDP right now, is where we have already overtaken that of US and China combined in terms of the real time transactions. We all know that right now, if you just have the smartphone, we can roam across the country without carrying a wallet, without carrying anything else. Such is the power of the mobile internet and the data, which is the biometric data, which is linked through Aadhaar. This is also one sphere where India's infrastructure is possibly ahead of what is there in the West and in the other developed economies. So there's something to be proud of. For us, for our discussion purpose, we all understand the political aspects. But just to reiterate a couple of points with respect to the political uh, view that one has. In fact, the view that we have got is that it's an event from the uh, perspective of governing the country, but from the economic perspective, it's not much of an event because there is a kind of consensus between the major opposition parties as well, and there would be a likely continuity of the uh, um, economy related initiative taken by the current government, even if the current government is not to be a part of the future governments. However, having said that, we should also be aware that what the opinions polls say right now, and I've not seen any opinion poll which says that the current government will not come back. In fact, all of them are trying to outdo each other and to say by what numbers the present government can come and how much more seats can they actually get. So that's the kind of different kind of competition they are having themselves. But from our perspective, we do who are expecting a continuity of the existing governance, continuity of existing policies, especially in the economy related initiatives and policies that we have got. And of course, the markets are driven much more by politics, and that is my the third part of the presentation. But before that, just let me also talk about like why this the growth can be sustained for the future, and that is the reforms measure which have been undertaken in the last few years. I have just noted down six of the major reforms which have been undertaken in the last 10 years, and we have begun to see the full benefit of that. The number one is push for manufacturing. The production linked incentive is close to 1% of GDP. It has led to the capex push by the government, and it has also meant that a number of quality companies have come to the country. One more is likely to come on Monday next, and they are putting up their dollars here, and as well as that of the creating jobs for the future. Just to give one example, in the push for manufacturing, that till about 4 or 5 years back, India was importing 97% of the smartphones, the high-end smartphones, but now India is a net exporter of the smartphones, and even the most leading edge Apple iPhone 15 Pro Max, etc., is also manufactured in India and being delivered on the day one. The second thing is the one nation, one tax. We all knew that the first few years were spent in the firefighting and there were teething troubles. But once those teething troubles were removed, so in the last 3 or 4 years, there has been a positive impact on the revenue collection by the government, so much so that in every budget, the collection is actually higher than what the estimated by the government. Now, this is the main reason is that the government has been able to reduce the fiscal deficit as well as grow the capex to infrastructure. Normally, we'd have thought that if the fiscal deficit is coming down, the expenditure will come down and the capex and discretionary spending will actually come down. But that did not happen. And even in the current year, there is a 70 basis point decline as projected by the government in fiscal deficit and 20 basis point increase in capex to GDP for the infrastructure. All that is coming because the tax collection, the revenue collection is stronger than what has been anticipated. And we all know that every monthly data which comes on the GST collection does surprise us on the positive. Now, combine this GST along with the unified payment infrastructure that has also brought in a lot of people under the formal economy, is that it is leading to a much higher formalization of the economy. And that's also showing up into stronger GDP numbers. The fourth one is with respect to REDA, is that we know that there is a parallel economy in the real estate sector, and there is a lot of opacity, and that was sucking the confidence of the prospective buyers itself. So the regulator, the RERA regulator, Real Estate Regulatory Authority, it was set up in 2017, as a result of which, at least initially, there was a lot of skeptics around that, both in the builders community as well as in the buyers community, and there almost stalling of the projects and the work for a couple of years. But once people realize that it's benefiting both the parties, builders in the form that it is giving, they are able to not chase the pipe dreams for only launching project, but they are able to complete and deliver, so improving their credibility. And from the buyer's perspective, because of the increase in transparency, now they were able to make even commitment for the projects not completed, because the builders were to give a completion date in a transparent manner and to adhere to that, which was missing earlier. As a result of which, we have seen that at least in the last 2.5 years, there has been a good pickup in the real estate launches as well as that of sales. And but since there has been a 10-year consolidation in this industry prior to this pickup in last 2.5 years, we do expect this trend to continue for a longer period. The fifth one is the bankruptcy law. In 2013 to 16, the NPA in the banking system was almost 14-15%, not only for state-owned enterprises, but also for some selective private banks as well. It was very, very high. The banking system was on the verge of collapse, but that's when the bankruptcy law was brought in, and the banking system's balance sheet was cleaned up over the next 3-4 years. The cleaning up led to initially some bit of losses, but now we know that the balance sheet of the banks are clean. The net slippage ratio are at a 20-year low. The credit cost is at the 20-year low. The capital is available for these banks, and there is a spare capacity. So if there is a future leg of growth, and that's what we are expecting in the economy, so that can be funded by the banking system. That wouldn't have been possible if the banks were saddled with 10 to 15% non-performing assets. Lastly, not to mention that India is also a festering ground for the startup ecosystem, which boasts of the third largest startup ecosystem after US and China. And but this is not only limited to the few cities or few states, but this startup culture is prevalent all across the country and in different spheres and the fields. Now I shall move on to the second part of the presentation, which is the Indian equity market. And since I'm mindful of time, so maybe I will increase the pace of my presentation. Uh, and I was talking about the corporate earnings when I said in my initial remarks that we have to see through all this volatility. The most important thing from my perspective, and I urge to all the investors that from their perspective, the most important should be the corporate earnings. If the corporate earning is strong, the stock market has to follow with a lead or lag. And similarly, when the corporate earning cycle is weak, again the result would be in the same manner, a weakness with a lead or lag. It's only a question of the timing differential that one can talk about, but by and large, the stock market return would be in line with the corporate earning cycle, because we know that the valuations are mostly mean reverting, and so in which case, even if the valuation expansion happens, so it will come back. So your net returns is close to the corporate earning cycle. So what we have the data here for last 30 years, and we have seen the multiple corporate earning cycles over here. This is the more famous one actually, when the stock market also became 4 or 5 times in this period. So corporate earnings to GDP was peaking at around 7%, and since then it has been consistently declining. This was the pandemic period, but before the pandemic also it was in 1.8 to 2% in just prior to that. But since then, again, it has taken off and continues to remain strong and robust. Now, this number will remain at these levels as long as the corporate earnings are growing at a pace faster than that of nominal GDP, and which is what we're forecasting even right now, that the forecast for the nominal GDP is close to about 11 odd percent, but the forecast for the corporate earnings would be in the low to mid-teens in the future, coming on the back of almost 19% CAGR growth in the corporate earnings in the last 3-4 years. And that is why this chart looks so promising and exciting. Now, the same data presented in two different manner, one with respect to the other countries, because there are a number of foreign investors who just want to compare the corporate earnings of India versus the rest of at least the rest of the Asia ex Japan. So this data is for last 17 years. The black line is the earnings of Asia ex Japan on 1 year forward basis. This dip is what you see on account of global financial crisis. And second dip is what you see is because of pandemic. It has also been rising. But nonetheless, over the 17-year period, which has been the earnings has been rebased to 100, the growth is only 1.5 times in the earnings. In the same period, India also witnessed the earnings to come down in the 2008-9 period, that is the global financial year crisis. This is all what we know is the pandemic period. There was a sharp cut in earnings, but there has been a much sharper rise also in the earnings. As a result of which, in the same period, Indian corporate earnings, represented by Nifty over here, has grown up 4.5 times. So that is almost 3 times more return as compared to the what one would have achieved in ACIX Japan. So this is one of the first and most important attractiveness from the Indian corporate earnings perspective. Second thing, if you look at the same data by its own history, then you see in the first decade of this millennium, the growth in the earnings was 12.6%, and especially in the period 4 to 8, it became 2x, more than 2x in fact, in this period, and then the growth obviously were much higher. In the next decade, from 2011 to 19, the growth was 6.8%, and that's when the growth in the earnings was weaker than that of nominal GDP, and that is the reason why you saw that dip in the corporate sector profit to the GDP. But since then, again, it has taken off, growing at 19% CAGR, and that's again we are seeing that the corporate sector profit to the GDP has been on the rising up. Now, in terms of the pure numbers, that Nifty forward premium is close to about 20x as compared to last 10-year average of 17.7x, which is about 1 standard deviation higher than the long-term average of more than 10 years. Now, why we are still able to justify is for a couple of reasons. Number one is that of in the previous slide, we saw that the growth is on an uptick. So it's not only growth, but there is an acceleration in the growth, and that is why it warrants a multiple which is higher than the long-term average. Now, if the acceleration were to die down, again, this multiple will begin to correct. But as long as the acceleration is there, there would be premiumness to the valuation. Second thing, equally important, is that what is the direction and a trajectory of the Nifty ROE, or any ROE for that matter. In our case, we have taken Nifty ROE. So here again, 10-year average is 13.7%. But in the current year, in the last couple of years, it has been inching up and going to 16.1%. Now, it should also be noted in the previous peak of the first decade of this millennium, this ROE was in the vicinity of 20% or higher. Since then, it has fallen, consistently fallen, but began to rise in the last 3 years or so. So these two factors combined, the higher, faster growth rate and the ROE, which has been expanding, will lead to a situation when the valuation is at a premium to the medium to long-term average. Now, yes, what has been helping the market in the last few years is the retail investors in India, which have been continuing to pour money. Our data is still December, January of, but since then also by and large the same trend is there, same growth is there. There's a 17% growth in on the inflows by the SIP contribution in the period of last 5 years. What was less than $1 billion US is more like 2.12 US dollar US dollar 2.12 billions. So that is 17% CAGR, and there is no signs of let up in this period. There are a few, just 1 or 2 hiccup, even for at something as major as that of the pandemic, or in the aftermath of that, actually in the pure shutdown period. But by and large, as you can see, this is as secular trend as you can get. This is just to recap, is that the third largest economy by 2027, structural reforms and demographic advantage are paving the way for long-term growth trajectory. Consumption in infrastructure and digital public infrastructure are the multiple drivers for the sustainable growth. The superior earnings growth also justify the higher valuation that we have got, and importantly that we have got a low correlation with the global and regional market, and macro stability is there to keep the macro as well stable. Now we come to the final part of my presentation, which is about a little bit about our funds that we have got, and here I will take you to also correlate with what I said with respect to the economy, with respect to the reforms, especially in the areas of reforms, and what we are doing. So the core of our portfolio construction is idea generation, which is from the investment universe of 450 stocks that is covered by our analysts internally. And within that, after the idea generation, we are focused on the earnings growth as indicator for resilient businesses and how you're able to grow at a pace faster than your competition, etc., growing market share. And second thing, what is the ROE progression? We saw for the market that the ROEs has been rising up from 13.7 to 16.1%. And but what about the company that we are buying? So indeed, in this case, also the ROE progression is quite important, among the most important parameters that we do look at. So the portfolios that for the large cap is between 50 to 70 companies, but we all know that by regulation, the focus fund, the number of stocks could not cross 30. So there I've got 28, 29 odd stocks here. Here, this data is for mostly for the large caps. Now, there are four pillars which are holding the fort of our portfolio right now, both in case of large cap as well as the focus fund. These are also the overweight sectors, the lending sector, that is financials, real estate, allied sector, healthcare, CapEx, and manufacturing. If you recall, the six reforms that I mentioned, and I will just quickly go back just to recap those six major reforms which have been undertaken. This one is for manufacturing and capex. This is also indirectly from the capex. This is from the real estate, and this is from the banking. Now let's come back to my four pillars. Actually, that you will see that there is an alignment of the three of them with the those areas where the government has been making serious reforms, and there is where there is a long runway for growth. Financials, real estate, allied sector, and capex and manufacturing. Which means that not only we have benefited in the more recent past, but will also continue to benefit in the more distant future also, because that's where the reforms has already been initiated or are in full flow, and the maximum benefit is coming to both consumers as well as the companies. Healthcare is on account of the fact that the situation, underlying situation improved in the US generic healthcare space, and Indian companies has become one of the bigger beneficiaries of the same. So that's my thought process with respect to what is my overweights in my portfolio. Let's look at the numbers. So large cap fund positioning, this data is as on March 31st, and the overweight sector here are real estate, healthcare, industrials, and energy. So these are the sectors which I have got overweight. In case of financials, while it shows underweight, but it is overweight in the lending financials. I do not have serious position in case of insurance and other agency businesses. Purely in terms of the absolute weight, this is what we have got. And this again reflects the thought process I showed you in the previous slide. Similarly, for the focus fund as well, my overweight sectors are industrials, healthcare, real estate, and financials, perfectly aligned with the four pillars of my fort, as well as from the perspective of in absolute terms as well. These are the four sectors where I've got the highest amount of weight. So that's all I had to say.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.